It is way easier than you think to get $1 million to buy a business. And I'm not talking about just for people that have money. In fact, last year, 9.1 million loans were given out for small businesses. Not $9.1 million, 9.1 million loans. I'm talking about hundreds of billions of dollars. And guess what? This is not to wealthy people. The vast majority of these loans were given out to people that are far from rich and have very little, if no, money. In this video, I'm going to change the way you think about buying a business and how it's possible for you. So first, we already talked about over 9 million loans were given out. The average size of these loans were between $450,000 to $500,000. Now, they go all the way up to 2+ million. Now, all of these loans are done differently. We're going to kind of break it down into 5 different loan types. First, we're going to go over SBA microloans. Now, really, these loans sit around, $15,000. These are small loans meant for really small businesses or help within a small business. This is not the vast majority of the loans. In fact, this is a much smaller segment of the market. Now, we also have online. People like Stripe will actually give out and lend money to online businesses to amounts of like $50,000. Now, online loans and online businesses require a few things, but mostly all they're looking at is working capital. So lots of times they will require nothing down for both of these loans. The reason that I love the online is I actually love micro websites and businesses that are cash flowing for $30,000 or $40,000. And because they're established cash flowing, they have working capital, you can actually lend with nothing down to buy those online businesses, and the business itself pays off that loan. Now, the next one we're going to talk about here are large banks. I'm going to hit on this just because this is more of a comparison. This is your conventional loan. This can be a very large loan. We're talking about $500,000 plus into $50, $80 million. Lots of times they're wanting to see between 20 and 35% down. And this is normally what people think about when they think about loans. Now, this is more of our benchmark here to show us where most people think, but what really are the options. The next one we dive into is the SBA 504, $300,000 plus. And this is really a lot of times for like real estate as well as working capital. This is a great one to use to buy a storage facility, mobile home parks, and others. You're looking at about 10% of what we call owner equity. Now, I'm going to kind of talk about that in a second after we go over the next one, because the next one is the most common. This is our SBA loan. Lots of people talk about this as just the SBA loan, 7A. The average size of this loan is around $500,000. Once again, we're talking about the average size, not what they'll borrow up to or lend. That's just the average size that is issued. And this requires 0 to 10%. So now let's break down these loans. Let's really talk about what is included and what makes it so you can borrow. The first thing you have to realize is when we're talking about loans with business and things like commercial real estate, this is not like a loan on your house where you think of just like a normal down payment. All right, so let's break down owner equity. Owner equity is essentially the piece that the bank isn't loaning against. So out of 100%, the bank will give you money for 90%. The 10% left over is this owner equity part. Something that a lot of people don't know is that 60 to 80% of small business that are purchased are involving in some way, shape, or form seller financing or their own piece of it that they're financing. Meaning that in lots of cases, the bank will cover that portion. Let's say it's 80%. Then the owner that owns the asset that's selling it, their piece in it that they're selling to you for 100, they'll leave in 20% as debt to them. That gets you to the 100% without you putting in your own money. That's part of the seller financing. Other pieces, the seller will actually finance almost the whole thing. You'll actually invert that. This is a big way that I started buying commercial real estate. We couldn't get loans, or we didn't have enough money for the entire loan. So we worked with the sellers, and the seller would finance the whole piece or part of it so that we could buy the asset. If the seller is financing it, they may flip the script and say, all right, I'll seller finance my personal business, but I want 30% out of it. The bank will come in and give the 30% down, and then they will carry the rest. That's why so much of this market involves in some way, shape, or form seller financing. You have to remember when we're talking about small businesses, the moment you say business, people think you're buying this $100 million enterprise, where the average small business in America sells at actually less than the average home in America does. All right, so let's break this down. Let's say you're buying a business that makes a profit. The business is selling for $1 million. Out of that $1 million that seller wants, you come to them and say, great, I'd love to purchase this. The bank is going to give me $900,000 to buy the business. So the bank comes in at $900,000. That leaves over $100,000 needed. The business is paying this loan down out of its income. Now you go to the seller and say, since I don't have that $100,000, what I'll do instead is you get that $900,000 up front. That $100,000 off that price tag, you hold, and I'll make payments to you and pay it off. Then the bank has this piece, the owner holds this piece. The amount still comes to $1 million. The owner is getting paid back on his business, but they got their $900,000 up front. Another way that we've structured it, and I've actually sold businesses this way, is with something called an earnout. So the owner wants $1 million, but maybe that's even a little more than you're willing to pay. So instead you say, listen, I can't do it all at once. We're going to do this in a couple chunks in a 3-year period of time. I'm going to give you $500,000 up front. And then as we go along in 3 years, we'll give you the remaining $500,000. So you break it up, and you can even attach certain metrics to it, saying if the business hits a certain level, we'll pay out $800,000. If it hits another level, we'll pay out $1 million. If it hits another level, we'll pay $1.2 million, meaning if it grew a lot. This is common in transactions, are earnouts. Or if they are wanting to sell the business, but they love the potential, you say, listen, you seller finance that $100,000. At the end of that 3 years though, that $100,000 on that $1 million that you seller financed, if the business does really good, I'll actually throw in more and add in another $50,000. So that way the owner's getting paid the full $1 million, they're getting residual on that $100,000, but if the business does good, they can actually make more money at the end. Another way that it is done besides seller financing is obviously you can use your own capital, or you can gather together investors like friends and family that want to put $100,000 down or even more into it so they can own equity in that asset or business. Now they have ownership and the business is paying them. And as that business grows, their ownership obviously therefore is worth more. That's one of the nice things about businesses and commercial real estates. They're assets, they have value, and they're growing. So people want to be a part of it. So there's multiple ways that you can construct these loans, that you can build out these loans. It is all going to be predicated on the business, how much it makes, and what you can pay. That is different for every single business. And we're going to dive into how that looks. But the first thing that you have to remember is the vast majority of businesses are small businesses. Out of the small businesses, 60 to 80% of them have no succession plan at all. Lots of profitable businesses simply shut down. Now, I know what you're thinking, especially because you think $1 million is a lot of money. Now, whether that business is worth $200,000, $100,000, $1 million, or $3 million, it's all relative to the cash flow. This isn't a home that you're buying. You're buying an asset that produces revenue. Now, you buy businesses based upon a multiple. Okay, there's lots of ways that you can value businesses that we're not going into on this asset. We're talking about loans and options to borrow. But at the end of the day, the cash flow from the business should pay for the loans and have money left over to pay you. So we usually buy businesses at a multiple of 1, 2, 3, maybe 4 times what that revenue and income looks like. That way you have disposable income to pay for the loan. Think about it like this. If I bought it for $1 million, money that generates should be able to pay that $1 million in 3 years. So it should be able to pay it off in 3 years. Just the $1 million. That's that excess cash flow. So the debt should be able to be paid off over time, whether that's 10 years, 15 years, whatever that looks like, from the cash flow of the business. And then have profit left over to pay you. And then all of the growth from that asset or business, that's just more profit that goes into your pocket. Now, this is just the loan part. There's other parts, valuating, finding, and more. Let me know in the comments what you want to know about, and I'll actually construct and make more videos on the subjects that you want to know about. Other than that, make sure you like and subscribe so you can see the other content around creating wealth through ownership.